Hello and welcome. Today we will be looking at Health Reimbursement Arrangements, or HRAs, and how they can benefit your business by making healthcare expenses tax deductible. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client, or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. For childcare business owners, staff, and educators, healthcare can be a major cost and substantial employment benefit. But for many childcare businesses, the cost of healthcare plans can be expensive. Accordingly, some childcare businesses are looking at more affordable options for healthcare that can benefit the owner and employee, but not swamp the business's budget. One of the most versatile and easy-to-implement options is a Health Reimbursement Arrangement, or HRA, formerly known as a Section 105 plan. These plans can work for the single business owner of a family childcare home who has an employee, to the large childcare organization with multiple centers, and everything in between. In this presentation, we will review what an HRA is, how it benefits employers and employees, and how to set one up. An HRA provides a way to reimburse medical expenses for employees and their families. By taking these expenses and making them a business expense, the money associated with them is no longer subject to income or corporate taxes, and these savings can add up. When you set up a plan, you set a limit to the total amount of health expenses that can be covered in a month or year for each employee and their family members. The limit needs to be the same for all employees, so an owner can't have a greater reimbursement, for example. You can administer your own plan or use a company to do so. Regardless, employees will submit appropriate expenses for review and reimbursement up to their limit. If an employee doesn't hit their limit for the year, the business owner does not have additional financial responsibility. For example, if you have a limit of $1,500 in annual reimbursements and your employee only submits $900, you only pay $900. These are the 4 simple steps to utilizing an HRA, once you decide on your setup. Step 1. Employer decides how much to contribute, and on what schedule. Step 2. Employee has medical expense and pays for it. Step 3. Employee submits receipts for reimbursement. Step 4. HRA reimburses employee's expense. We will go into more detail on how to set up a plan later in this video. These plans cover a wide array of costs, including many that are frequently used by employees and some that are not often covered by other more traditional health insurance plans. These include costs such as deductibles and copays for checkups, surgery, and other services. They also include the following: health insurance and long-term care premiums, dental health and surgery, prescriptions, vision health and surgery, eyeglasses, both prescription and reading glasses, and contact lenses, laboratory fees, over-the-counter health costs when prescribed by a doctor, such as eye drops, acne medicines, sleep aids, allergy medicine, orthodontia, chiropractic care, speech therapy, acupuncture, psychiatric care, medical imaging, and x-rays, counseling, OB/GYN fees, specialized schools, medical devices such as walking aids, vaccinations, physical therapy, and infertility treatment. How can HRAs benefit you and your business? The savings can add up quickly. On average, business owners alone save around $5,000 on taxes. But the savings in self-employment and income taxes can vary based on the business. Let's look at 2 examples. There is a family child care provider who is a sole proprietor and is in the 22% income tax bracket. She had $6,000 in health insurance premium costs and $4,000 in out-of-pocket expenses, including copays, prescription drugs, and eyeglasses for 2 family members. Her spouse is not eligible for health insurance, so she can deduct all of her $6,000 in insurance premiums. If her spouse was eligible for insurance, even if they turned down coverage, these would not be deductible. Using the personal health insurance deductible for self-employed people, she can deduct only the health insurance premiums off of her income. So, she still pays self-employment tax on the $6,000 of business income that she had to qualify for this deduction, but will save on personal income tax. The out-of-pocket expenses are only deductible when they exceed 7.5% of her adjusted gross income. In most cases, ordinary healthcare costs don't reach this level, so these costs won't be deductible. Our costs without an HRA are shown on the left. As you see, this provider had $10,000 in health expenses and theoretically paid $10,210 for it. Now let's say she had an HRA. She can now deduct the full $10,000 as a business expense, eliminating both self-employment and income taxes. Our savings are shown on the right. As you see, this same provider had $10,000 in health expenses and paid $6,270 for it. Through an HRA, the provider saved an additional $3,730. Now let's explore a second example, this time for a center that is a single-member LLC, so it is treated as sole proprietorship for tax purposes. The center owner has 4 employees and has hired her 16-year-old daughter, so she is eligible for her costs. We'll go into that more a little later. She sets up an HRA with an annual limit of $1,000 as a way to increase compensation for her staff. The table here shows the amount of reimbursement each employee used, a total of $4,550 altogether. Let's now see the impact on taxes for the employer and employee. What is the impact on taxes for the employer? The employer only had to pay $2,761.85 in reimbursements, lesser tax savings, to offer this $4,550 benefit. And how about our employees? They will save on the employee side of payroll taxes and income tax. Assuming they are in the 22% tax bracket, their income tax savings would be as the chart illustrates. In this example, we can see that not only did the owner benefit, but for $2,761.85, she was able to provide a potential $5,899.07 in value for her employees. You may wonder how this differs from a health savings account. Many employers may also consider a health savings account, or HSA. While an HSA can be valuable, an HRA tends to be more versatile and beneficial. One fundamental key difference is that an HSA must be paired with a high-deductible health insurance plan, while an HRA can be used with or without offering a business health insurance plan. The table here provides a brief summary of additional differences between the two. Other notable differences include that with an HSA, contribution limits are set by the government and are capped at $3,650 for single employees and $7,300 for married ones, whereas with an HRA, the upper limit is set by the business owner and can be at any level. Another difference is that with an HSA, the business owner needs to contribute to the annual limit even if the funds are not used in a given year. With an HRA, the business owner only pays for the submitted reimbursements up to the annual limit. Health savings accounts have a narrower number of eligible expenses focused on medical services. Health reimbursement arrangements can include a broad array of physical and mental health services and even other costs such as prescriptions and medical devices. And lastly, the HSAs have greater record-keeping requirements, whereas the HRAs are easier to implement. Does your business qualify? Businesses with W-2 employees can qualify for an HRA. However, how you implement them and how business owners who are not W-2 employees can benefit depends on the type of business you are. Here are the different paths for each business type: C corporation or an LLC treated as a C corporation. Since all the company employees, including the owner, are W-2 employees, it can be implemented easily for everyone. You would put a plan in place and start accepting reimbursements. Sole proprietorships, partnerships, single-member LLCs, or multi-member LLCs treated as partnerships. Any W-2 employees will be able to enroll in the HRA, however owners and partners will not. If you can legitimately employ a spouse or child as a W-2 employee, you are able to utilize an HRA for that hire. HRA coverage extends to them and their family, including yourself. For example, a family childcare provider who is a sole proprietor can hire a 16-year-old daughter part-time and create an HRA for the daughter that includes all family members: the daughter, the owner, a spouse, and siblings. S corporations and an LLC, treat it as an S corporation. All existing W-2 employees and any owners who own less than 2% of the business can participate. Any owners who own more than 2% of the business, even though they are W-2 employees, cannot. Further, relatives of the business owner are considered in this case to be 2% or greater employees, so cannot be used for eligibility. However, some business owners will create a separate sole proprietorship and employ a relative through that company to gain an eligible W-2 employee. This clearly needs to be justifiable for the business, so make sure you do this in coordination with your tax professional. Here is how to set up a plan. You can hire a company to implement the plan for you or have your business implement it directly. To start, you will want to create a plan document with the rules around the plan. You will want to include the following: which employees and their relatives should be eligible. For example, you may want to include only full-time employees or those who have been employed with you for a certain number of months or years. The timing of reimbursements. Typically this is monthly or quarterly to ensure timely payment, and any rules around it, such as having to get payments in within the 30 days of the end of a month or quarter. Eligible expenses and any exclusions. With any limitations or timing, such as having to use your existing insurance first. Employer contribution limits, including the maximum benefit for a set period of time, such as for the month or year. Keep in mind that this should be considered reasonable compensation, so you don't want to exceed their current pay. So if you hire your spouse for $5,000 a year, you should not allow benefits to exceed that level. These items need to be captured in a plan document. If you use an outside company, they will likely provide this document. You should also have a simple form for each employee so they can list eligible dependents and acknowledge that they are opting to participate in the plan and that it may end at any time. A form like this should be signed and dated by every employee wanting to participate. You will need to report the plan to the government. Every year by July 15th, you need to file a Form 720 with the federal government to pay a small tax for each participant. Don't worry, the tax is small. For example, in 2022, the maximum fee was $2.79 per average participant. To complete your Form 720, start with Part 1, where you will enter your business information at the top. Then move to Part 2 on page 2. You will want to enter the information on IRS, number 133, Patient-Centered Outcomes Research Fee. Specifically, under applicable self-insured plans, you will enter the average number of employees covered for the year in the column, and then multiply it by the rate in column B. The line you should use will be determined by when your plan year ends. For example, if you started your plan on November 1, 2022, the plan year end would be 12 months later, October 31, 2023. You then multiply the average number of employees by the rate to get the fee in column C and the number for the tax column. In Part 3, you will want to put the total tax from Part 2 on lines 3 and 10. This will be the amount you will send to the federal government. Also put in your name and the date, and make sure you sign before sending. Finally, you should send a check written to the U.S. Treasury and mail it to Department of the Treasury, Internal Revenue Service, Ogden, Utah 84201-0009. Note: you use the same address, no matter which state your business is in. For more information, visit the Child Care Collaborative of Iowa website or email fmc@midsu.org.